Hello, and welcome back to Pay Down Debt Solutions. I'm Jen, and on this channel, we teach velocity banking, and we teach velocity banking also when it comes to mortgages. So today, that's exactly what we're going to do. We are going to get into mortgages backed by popular demand. We have many of you out there that have emailed us asking whether or not you should do cash out refis, okay? And, cash out refis and maybe velocity banking on top of that. So let's take a good look at this today. But let's talk about a little bit about just that cash out refi in general. So in most cases, we're going to tell you not to do that. Okay, so not to do a cash out refi, and especially do not do it if you are not going to do velocity banking on top of it, right? Because all you're doing is resetting the clock on that amortization schedule. Okay, so if you guys understand what an amortized schedule is, you know that when you have a mortgage and you take out a mortgage, that the schedule that you are on to keep you on normal, regular payments, they will divvy up the way your interest and your principal is allocated to that mortgage, okay? And it always favors the bank. So what happens is when you take out a mortgage and you refinance or you purchase a home, you're going to get a mortgage and they will put it on an amortized schedule so that you have a set payment so there are no surprises every month, okay? So what that means is what the bank will do is they will set this schedule for you, and they're going to set it so that the interest, the most interest that you're ever going to pay, is at the beginning of that mortgage. Okay, so the most interest you're ever going to pay is at the beginning of the mortgage, and it trickles down towards the bottom. And conversely, the least amount of principal you're ever going to pay is at the beginning of your mortgage. And as that mortgage goes on and moves down, you pay more principal over time. Okay. Just as you pay more interest in the beginning and less at the bottom, you pay less principal at the beginning and more principal over time. Okay. So inverse relationship, right? And I say that plenty of times. Okay. So what happens here is you guys know that in the first couple years of your mortgage, the bank is winning big time over you, okay? And they also know our habits. They know that habitually we are either going to refinance in a few years or we are going to move, because that is what most Americans do. Within the first 3 to 7 years, you're going to move or refinance. And that's pretty much, how it works, okay? So the banks know this, and they set your schedule and they set our amortized mortgages so that it always favors them. So whether or not you refinance or move, then and you're going and move, if you move, you're going to get probably another house, right? And if you do that, then you're going to get another mortgage all over again. And if they've done a good job, they're hoping that it's going to be with them. Okay, so that's how this kind of works. And so when we talk about refinancing, I'm going to tell you probably not to do that. Now, there may be some situations where you can refinance, drop your interest rate, and then do velocity banking on top of that. And that may or may not make sense, right? And at the end of the day, you have to run the math on it. Remember, everything up here is what you're going to use, and that is all you need to run the math and figure out whether or not that is advantageous to you or not. So I am guilty, and Dan is guilty, right? We are guilty of refinancing. We have done it at least 3 times in this house, and we've been here for 20 plus years. Now, if you think about that, the banks are getting a whole lot of money out of us, right? Because we have done it where we refinanced in the first couple years so that they got a bunch of interest, and then we reset the clock on ourselves again. And then when the car companies were having trouble, remember, Dan and I, we are business owners, yes, but we also worked for corporate America. I was a banker and a branch manager. Dan was and still is a mechanical engineer, and he worked for one of the big 3. And so that during that time, okay, and I think it was 2008 when the car companies were in a bunch of trouble, we were in a position where Dan was faced with a buyout. And so that's actually the beginning of him starting his own businesses and starting, well, I should say getting back into owning his own businesses, because he owned a yacht restoration company when he was younger. Well, so Dan ended up leaving, and we did a mortgage, a modification on our mortgage. And that was the stupidest thing we could have done, because we didn't really realize at the time what we were doing, okay? So modifications can be tricky, and the guise of them is to save you some money, okay, so that to drop your payment. But what happens is they're extending the term on your mortgage, okay? So you go from 30 years to maybe 40 years. And I have seen this a few times now, even with students. So that is one thing they do. They will sometimes do just a rate modification. So they might do a time modification. They might do a rate modification to drop the interest for you. But at the end of the day, you guys, when you really think about it, is that rate modification or the change in that payment going to make or break you? It's probably not going to be significant enough to save you from, losing your house if you're faced with that kind of situation, right? But what is going to save you is learning to bank a different way and learning to run velocity banking. That would be more advantageous to you than refinancing, thinking you're going to drop your rate by, drop your payment by 150, 150, maybe $200. That probably isn't going to be enough to save you in many cases. Now, if it is, awesome. All right, that's great. But a lot of times it's not. But what velocity banking does for you is it gives you back your payments. Okay, so a lot of those payments that you're making, if you run your finances through velocity banking, you're going to save yourself a heck of a lot more money than just a couple $100. Okay, and that might be extremely advantageous to you. All right, so anyway, like I said, Dan and I are guilty too. We've been there, we've done that, we've done refinances. So none of the things that I'm saying to you have not applied to me, because they have. All right. So I am just as guilty as anyone out there. Now, the other thing I want to talk to you about mortgages is this. I've had a few students tell me, and I found this very interesting, that they thought that that they had to refinance. Okay. That they thought they had to refinance every few years. They didn't know it was an option. They thought that they had to do that. And I had another one say that to me this past week. So you guys, just so you know, anybody out there, you do not have to refinance. That is not something you have to do. Banks approach you because they look at it and they think you're in a good position to do that based on all the research that they've done. They pay a lot of money to do research on homeowners out there, and they know where you're sitting and what you may need to do. And so in a way, I guess you could look at that as predatory, because then they start approaching you, they start calling you, they start sending you mailers, they try to get you and entice you to do something that you probably don't want to do. All right. So if we take a look at the refi, okay, so I call it the empty refi. And empty meaning you're not putting anything more into it. You're just doing a straight refi. There is no cash out. Okay. So if you're doing a refi for rate or payment reduction, okay, so let's look at this example. And it's actually an example that I'm going to pull from my numbers today, because I am going to run a scenario for you, and I'm going to show you. What we're going to do is we're going to run a student scenario of $300,000. They purchased their home for $300,000. They are into it 3 years at this point, and they have $45,000 in debt. And their numbers you guys are going to be familiar with, because I did pull them these numbers from and use them the other day. Okay. And so we're going to then talk about a $45,000 in debt and taking care of their mortgage, chunking it down. Or should they do a refi? What should they do? How should we look at this? Okay. So this is really good timing. And, like I said, there are numbers you're going to be familiar with. Now, if we take a look at this empty refi, meaning again, there's no cash out here. They have a $300,000 mortgage per se. Okay. So we're just looking at this as a hypothetical, at a 7.2 interest rate for 30 years. And if they're 3 years in, okay, now their payment is currently $2,036, and the interest paid is $56,850. Okay, their total interest is $433,091. I'm sorry, $433,091 over 30 years. Sorry, guys, I'm tired today. I apologize. Over 30 years. So this is what they would pay over 30 years in time, right? So then their total payments, okay, so that the interest plus their payments would come to $733.91. Okay, so $733,091 over 30 years again. So if we take this, all right, and we've paid $56,850. And let's say after 3 years, they do a refi. Okay, so they refinance this. And let's say their closing costs, because remember, you guys, your refinances come with fees. Okay, they come with closing costs and they come with fees. And $8,200 is actually cheap. It's more like $20,000. But we're taking $8,200 for here in this case, because sometimes you can buy it down, or the loan officers will take certain deductions, in giving you a higher rate, things like that. There's things that they do. Okay. So let's say it's $8,200, the refi closing costs. Okay. So now we're looking at refinancing in 3 years, $299,888. Well, it's almost 300,000 now, isn't it? Okay. So, but let's say we went from a 7.2 and we were able to drop it to a 6.325. All right. So we've dropped our rate almost a full point. All right. So now our payment is $1,861. So it has been reduced from the 2036. Okay. And our total interest at this point, the total interest over 30 years is going to be 370,113. So 370,113. The total payments amount is going to be $670,001. All right. So this seems like a deal. Maybe this is a deal, right? So this looks like it could be a deal. Well, let's think about it. Is it a deal? Let's look at it. Okay, so if we look at this, we're 3 years in, right? We take this away and we look at it. We're paying $426,963 in interest in over 33 years, though. Remember, because we're already 3 years into this. So now we've reset the clock and we have to add the 3 years that we've already paid. And we also have to add the $56,850 that we've paid. Now, so this seems like it's a deal, right? Because we're paying $426,963 in interest versus the $433.91. Okay, so is this a deal? Well, here's something that you might have to look at too when you look at these schedules. We started this, okay, partially through the year, and they're 3 years in, right? So that means that the $56,850, actually, we need to add about $7,000 onto that to get to compare apples to apples for a full year. Okay. So for a full 3 years and not just, two something, a partial year. So if you add $7,000 onto that, and let's just say it's an even 7, even though it's a little bit more than that. So if we do that and we take 426,963 and we add 7,000, so that brings us to, right, $433,963. So it's pretty comparable, let's say. To do this, it's a little bit more, but it's pretty comparable. But here's what you've done. You've refinanced it and you've extended it out now 3 more years. You've extended it out for yourself, okay? Here, you're continuing on. You still have this payment, but they're 3 years less, right? So it's 3 years less than this. This may or may not work out for you. Now, if we weren't doing velocity banking, maybe you consider this to save yourself this payment. Maybe you do, okay? Maybe that's what you do, and that's what a lot of people do. And again, that's why they do this at 3 years, because that is the most advantageous, right, way for them to get you to refinance and get more interest out of you. Because again, you are paying that interest over again. You are, without a doubt. So if you look at it from the bank's perspective, about 3 years in makes the most sense for them to try to get you, because if you do the math on it, you're going to go, well, my payment's less and I'm not really paying much more. So yeah, maybe this will make good sense for me. So that's how they get you. And I want you guys to keep that in mind. Okay. I want you to do that. Now, let's take a look at this 10 years down the road instead and see what happens when you are approached about refinancing. So here we have $260,545 at 10 years. That's where our balance is at, okay? And we have paid in this 10 years period of time $196,756 in interest paid. And now we're going to refinance to, let's say, this 6.325%. And our payment then drops to $1,666, which is cool, right? That's great. Helps us, drops our payment some. So our total interest at this point paid is going, if we refinance this, is going to be $331,430, and our total payments is going to be $599,975. But again, remember this, you guys. This is a 30-year mortgage, right? 30 years. While these numbers look great, you have to also remember we are 10 years into this. So now we have gone from 10 years to 40 years to pay this mortgage off, right? So it's 40 years. So now let's see what happens. And by the way, I'm taking this, all right, we have to take the 260 for 545 plus the 8,200 in closing costs. So that means we're starting with the 268,745. Okay, so when I show you these numbers, that's where I'm getting the initial numbers from. So let's look at that. Okay, so again, like I said, it took 40 years, right? So 40 years and $528,186. How do I get that? Because I have to add the 196,756. So to drop this payment, okay, from our 2036 to our 1666 is costing us a whole lot of money on the back end. So when you guys are sitting there doing your banking and you're traditionally banking, you haven't learned how to do velocity banking, and you're sitting looking at this, there's lots of things going through your head. And at the 3-year point, this might make sense for you. Okay, it might. And maybe you don't have any choice because you have to drop your payments because you have some debt out there. You've got to drop your payments. You have to do something. And so you refinance and you extend it out another 30 years on top of the 10 you've already paid, because you are saving yourself what? Almost 400,000? I'm sorry, not 400,000. $400. Whoa, I'm having a day. So anyway, so that for, you might have to do that, right? Or you might think you have to do that. That's the key word. You might think you have to do that. So what I'm going to show you now is a different scenario. So the students that I'm working with now, we have looked at this and we have decided what we're going to do. We're basically looking at it and saying, okay, well, what steps do we make? They were considering refinancing, okay, and taking out $45,000. And I said, well, hold on a second. Let's take a look at using a home equity line of credit, because they haven't done anything with their mortgage. I think I told you, they did refinance 3 times, just like we did, actually. I don't remember if I told you it was them or us, but anyway, we refinanced 3 times. This would be their 3rd time, I should say. This would be their 3rd time refinancing if they do it. And so they have a whole bunch of years there that they have paid a bunch of interest on that they would be resetting the clock on, okay? And we have to add those into our numbers at the end of the day. So when we take a look at this and when we look at the home equity line of credit and show you what you can do with velocity banking, we are then going to compare it. So I am going to clear my board here. I'm going to bring back their numbers so you can see them. And we are going to put this on an amortized schedule, and we are going to work this down through velocity banking. So give me about a second. Okay, so now that I'm back and I have some numbers written on the board for you, and I have a wonderful amortized schedule here for you as well for the mortgage that is in question that we're working with. And again, I said these numbers, some of these numbers here would probably be familiar to you, and I'm sure that they are. So they had more going on here, and I added, the extra that was going on the board. And the real mortgage amount for you from the other day, it was a different mortgage amount, but this is actually their real mortgage amount. And I did just take and round these numbers just to simplify it a little bit for you, okay? Well, I guess I should say for me. And I did realize that my board, I was off the board on the first video portion, and I apologize for that, but you didn't miss anything. It was just, I talked you through what we were going to do, and obviously it is running down the mortgage using a home equity line of credit and using velocity banking, okay? So remember, we give you guys choices. It is up to you to make those changes. If you want to change how you're currently running things and what you're doing with your mortgage, could you pay an extra payment a year? Yeah, you could. Could you put your extra cash flow on that mortgage each month? Yeah, you could do that too. But here's the thing, how many of you actually do it? And that is the problem with that. When you run things velocity banking style, right, and you put a chunk down on your mortgage, what happens is it's already done for you. You already did it. So it's not something you're committing to every single month. So that's what happens with cash flow. There are so many times that I see people want to hang on to their cash flow because they have something coming up or something that they want to do with their money. And so they hang on to it and they don't do the things that they tell themselves they're going to do or want to do with it. So when you do chunks like this down on your mortgage, it's already done for you and you're running it velocity banking style. So if something does come up during the month and you have expenses that are just a little bit higher, you guys can take care of that through running income in and expenses out of that line of credit, right? So it doesn't derail you. And you're already taking care of your mortgage in the process because you've committed to that chunk that you're putting down on the mortgage, and you're also running your finances as you would every day. And so that is another thing that I find so incredible about doing and running your mortgage this way and paying it down faster using velocity banking. So These students here, and let's just do a rundown on them. They had a lot going on. They did end up getting a home equity line of credit, okay, and we're going to take care of their expenses or their debts, okay, through the home equity line of credit, and then we're going to start chunking down on that mortgage, and I'm going to show you what that's going to look like. Now, some of this here is going to be, I'm taking an estimate, right? So I'm not drilling into the numbers exactly, but you're getting a really good estimate of what that's going to look like. And actually, when I do my estimates, I always swing it in the favor of the amortized schedule so that your real outcome should actually be even better than the numbers that I get for you at the end of the day. All right, so let's take a look at this. Again, income here for them is actually $8,600. Their total expenses, $8,400. Their cash flow then is $200. Their mortgage, just like the numbers in prior today, were $2,036. They have 3 cars going on. They have a son that they paid for a car for, and they have their own cars, okay? So we have a mortgage, again, the payment is $2,036. We have, the first car is $445, second car is $816, it's actually a truck. And the third car is $336, and then we have an equine expense, which is why they need that truck, of $1,056 a month, okay? So everybody, you guys each have your thing going on, right? And you guys have to do you, just like these guys are doing them. YOLO, we have only one life to live, and I want you guys to live it. And if they want to spend their money on equine expenses and they show and do all that, good for them. Let them do it, but let's pay down those debts, let's get rid of those debts, and let's do it smarter with more education rather than running things the traditional banking way, because you guys are smarter than that now, right? Okay, so these expenses here add up to $46.89, and then they, of course, they have living expenses as well, which has to come off the top. But anyway, so remember, they had a Discover card here for $5,500 at $179. This is the interest plus 1%, okay? The interest plus 1% is what they're paying on that. And the Chase card at $16,500, sorry, I forgot my comma, and that is for $536 at 25%, 4.2 years to pay that back, $10,145, that's not changed. And then Capital One, they have $23,670, 23%, 4.9, and $14,824 to term that out. Which means they then would spend $28,665 in interest to take care of $45,000 worth of debt. All right, so now you guys know they've already refinanced twice before. They were contemplating refinancing again when we had a discussion, and I do know these guys, so we did talk with them in person, we know them. And so we came up with a different solution for them. We came up with something different rather than refinancing that, taking cash out and moving forward, okay? So HELOC, 10.75%, $60,000 is what they can get for that out of their equity in their home. So that's what they're going to do, all right? So when we start our scenario here, okay, we're gonna take $55,000. So $55,000, and we know that their income is $8,600. Now, again, why is it that they can use their entire income rather than holding out non-chargeables, right? Well, remember, you're running things through a home equity line of credit. When you do that, that means you can put all of your income into that debt, onto that debt, right? And you can run all of your expenses out. As long as you're going in the right direction, which is reducing it monthly, right? Then the scenario and the velocity banking strategy works, okay? So that's what they're going to do. They don't have to hold anything out. They're going to put all of their income onto that line of credit. They're going to then pay all of their expenses out, and they're going to continue to do this. And those expenses are actually going to then swing back into their checking account and get paid through auto drafts, okay? So that's how they're going to do it. Now, the question all the time becomes, hey Jen, I don't understand why would I put it all onto that line of credit and then take it all out again just to pay my expenses, or most of it out again? Again, you guys, it's putting that money in to drop your average daily balance, because that is how you win, because you're dropping that interest, right? And you're going to win again if you stave off those bigger expenses to the end of that payment cycle. okay? And so if you can do that, if you can push payments to the end, you're gonna save even more, all right? So that's why we do it this way. Now, we start out with 55,000. We didn't go all the way up to the 60, we were taking it to 55,000. Remember, we have to take care of this debt here, the 45,000. We are going to take it up to 55 because our first chunk down is going to be 10K onto that mortgage. And we're doing that because we know they're 3 years in, approximately 3 years in. And we want to take advantage of making sure we take and jump the schedule so that we can skip paying a bunch of interest. We're trying to save ourselves as much interest as possible, knowing that this is front end loaded, right? All of the big interest is paid up front. So we're going to take 10,000 to begin with, and we're going to slap that down, and we're going to handle our debts. So 45,000 of this is debt. The other 10,000 is going towards our mortgage. All right. So if we take this, we take 55, we're going to slap on the 8,600. It drops us to 46,400. Then our expenses come in, okay? So where are we getting our expenses? Because our expenses have changed now, haven't they? Well, of course they've changed, because we have then gotten rid of this, we've gotten rid of this, and we've gotten rid of this, which means we can reduce our expenses, can't we? Because we don't have them anymore. So if we take 8,400, you subtract off the 179, you subtract off the 536, and you subtract off the 670, we then come up with $7,015. And that is what the new expenses monthly are going to be. All right, so we add our interest back in, right? And our interest is based on the 10.75. So remember, for all of you that are learning this, right, how we calculate our interest, we take the 55,000, our high balance, we add it to our low balance. So we add 55,000 plus the 46,400, we're gonna add them together. We are then going to divide by 2 to get our average. Remember, average daily balance. You take the number you get from that, the average, okay, you take that average and you're going to multiply it by 0.1075, okay, that's our interest. But that gives us a year's worth of interest. So we must then divide it by 12, which is going to give us the 454. That is how you calculate your interest when you do this, all right? So then it drops us, we end up at 53,869. Do our checks, is 53,869 higher or lower than the 55? Well, it's lower. We know we're going in the right direction. Okay, now this takes us 36 months. It's 9,251 in interest to run this. Okay, now what did it actually cost us though to take care of the debts? Well, if you run it without the 10,000, it's going to take us $5,687, and it'll take us 27 months to destroy this debt. I'd rather pay $5,600 versus $28,000 every day of the week, right? So even if they didn't do the $10,000 chunk and they wanted to take care of this debt, they are going to do much, much better in a much better time frame, right? What is it, 27 months? So just a hair over 2 years versus your 4.2, 4.9, or 4.5. So you're having that time frame, and you're doing more than having the interest, aren't you? So this is why we do velocity banking, you guys. And so when we're not talking just mortgages and we're talking debts in general, this is why we do it. You don't need a home equity line of credit. You could use a personal line of credit. You could use even credit cards to get this done, okay? Now, so we know it took 36 months to do this, right? And it took $92.51 in interest. So now let's apply that to our mortgage, okay? So moving forward, we remember, when we start this, we're taking a $10,000 chunk and we're chunking it down right away, okay? So what does that do for us? Well, as we're running this, we have now skipped ahead 3 years in the schedule. Remember, that is just a $10,000 chunk, so that's why this is smaller. So we've skipped ahead 3 years, okay? So what have we done? Well, we've paid $59,394 to do this 3-year jump, okay? So that's what we've paid in interest. Because remember, we still are paying our mortgage during this period of time. And yes, we're jumping the schedule, and yes, we're putting $55,000 down in chunks at a time. Well, we will be going forward because the first chunk is 10. So you're putting a chunk down, but you still have to pay your mortgage, right? So you're still paying mortgage and you're still paying interest on that mortgage while you're doing this simultaneously. That's happening. So that's why I've broken it down here for you to show you your first jump is 3 years. You've spent $92.51 and total, okay? And granted, some of this went other places. So the numbers are a little bit skewed because of that, because it's not just mortgage. We have some debt in here too. All right, so we have $92.51. We've spent $59,394 in interest, right? So in our interest, that's what we've paid if we add it up. So $68,645 is what we've spent in the first jump in interest total, combined with HELOC and with what we've paid just running our mortgage every single month, right? Okay, so that's our first jump. Now, our second jump is our biggest jump, okay? And that jumps us 6.5 years in the schedule, all right? 6.5 years. And so we started here, okay? And again, I'm approximating this, you guys. I'm approximating this to give you a good idea. I'm not running it into the fine-tuned detail, okay? So we jump 1, 2, 3, 4, 5, 6.5-ish years, right? Because we're somewhere in here is where our $55,000 takes us, okay? So we've also skipped in this period of time $131,142 in interest. Get a load of that. You have skipped that much in interest. I think that's pretty incredible. So now you've spent $53,411, but skipped $131,142. So you've made gains here, okay? Because remember, the second jump, we're still spending $9,251 because we're doing $55,000 chunks now at a time. And you've spent $44,160, okay, in interest, okay? So that's the interest you've paid to run the schedule for 3 years, all right? So then it takes us down. So that was year 1. Now we've got year 2. So here is year 3, which is our third jump down here. So year 1, this is year 2, and this is year 3, down here is year 4. So year 3, what have we done? We have, again, run it for $9,251, right? $9,251, and we have spent in interest $21,544. Now, you can see the interest is decreasing, right? Because as you're jumping the schedule, remember, amortized mortgages, your interest is high, right? And it comes down as you get closer to being done with the mortgage. But when you jump this way, you guys, you're jumping and putting yourself at that interest level. So it doesn't reset you back to, paying the interest up here. You're paying the lower interest because you've jumped the schedule. So that is why velocity banking is amazing, and this works so well for you, all right? Okay, so third jump is where we're at, right? $21,544 is what we've spent in interest. So the total we've spent is $30,795 to get the third jump done, okay? Now, our last jump, okay? So our last jump takes us to, we spend $9,251. We've spent approximately $11,000 at this time in interest, and that brings us, how does this add up? Oh my gosh, what did I do? Ha! Pretty funny. Sorry, guys. That was, I think, 20. I think that was supposed to be 2251, I believe. Let me just add it real quick for you, if I can find a calculator. Okay, I told you I was tired. I wasn't joking. Okay, so we had a graduation party we went to. Very, very, very fun. Loved it. Had a great time. But a little hit from it. And my brain's not working like it should. So yes, $20,251. All right. So $20,251 is what we've spent to do our fourth jump. Okay. And then to finish the mortgage out. Okay. So it jumped us and we were down to about $17,225. So to finish that last jump, we've spent $611 and it was 6 months to finish it, right? Now, we were going to spend, right, remember this, $433,091. That's what we would spend to run this $300,000 mortgage for 30 years, okay? That's how much it would cost if we did not do our velocity banking and did not jump our schedule. So what does it look like? All right, remember, in 3 years, they've already paid this, the 850. Look, we have spent now to do all of this, okay, $229,952. It took us 12 years plus 3, right? It took us 12 years just to do this, but it took us another 3 years on top of that. So it was 15 years total with the 56,850. So we have spent $229,952 versus the 433.91. Okay, so what is that in savings? Let's take a look. So if we were to have paid 433,091, but we subtract off the 22,952, so we've saved $200,000 on our mortgage. $200,000, you guys. That is incredible. This is why we do velocity banking. Now, the next time we meet, I am going to then take this whole idea here, and we are going to then do a cash out refi and run that cash out refi through velocity banking to see what it would be, okay? Now, in this case, if they did this, okay, and remember, they would have to add $45,000 to do that. So that means their mortgage then would be pushed back up to $344,888. And it's going to be a 30-year mortgage, plus their payment is going to be $2,248.41. So next time we will take a look at that and see what that is going to do for them, okay? So if they were to do a cash out refi that way. But you have to remember, at the end of the day, they still paid, whatever we do, we still have to add this $56,850 on top of what they would pay here. So if their interest in this scenario here, just adding the 45, right, is $464,540 in interest, we have to add another $56,000. So that takes them well over $500,000 in interest. So it'll be very interesting to run this scenario down if they had done that refi that way. They're satisfied with the home equity line of credit right now. This is how they're going to do it. But what would they do if they wanted to do a refi, if they were going to do a cash out refi and we ran it through velocity banking? That would be the next question. The other thing you have to remember too, guys, they're actually going to save even more than this here, because when these are taken care of, and there's two of these cars are almost done, right? They'll be done in 2 years. And the other car will be done in 4 years, I believe. So these payments are all going to come back to them, right? They're all going to come back. And that means we can deduct these from our expenses, which means it's not going to cost them $9,200. It's going to cost them much less, which is why I said they're pretty happy about what they have going on so far, knowing that it's going to be even more savings down the road. So again, you guys, use your noggin. All you have to do is think it through. Think it through with velocity banking. Run your strategies. You don't need any crazy programs, you guys. You don't. All you have to do is run your scenarios, just like I ran this for you today. I hope you guys have learned something today, and I will be excited to run the next one with you to see what that's going to do for them. Have a great day. And if you want our worksheets, you guys go ahead and email me. I will send out our worksheets. What the worksheets will do for you is allow you to organize yourself. You'll get organized. You'll be able to look at things, whether they're chargeable or non-chargeable, and it will help you really get a good foot in the door with velocity banking so you can figure out your strategy. So by all means, email us and we'll be happy to send those out to you. Have an awesome day, and I will see you in the next video.